This is David Goldman, Asia Times Deputy Editor, speaking to you from New York City, the evening of June 23rd. Well, hyperinflation has hit the American home market, at least in the view of one respected research analyst in housing, Ivy Zelter. This is after the National Association of Realtors reported that home prices had jumped 23% year on year, something we've never seen before in the entire history of housing. If you look at the first chart, you'll see the blue line. That's the median sale price of American homes in the last couple of months, and it's gone completely parabolic. Hyperinflation might be a bit of an exaggeration, but there is a deep reason for it, and that we see in the second chart. For the second time on record, mortgage rates are lower than the rate of inflation. So from the standpoint of the average household who sees prices jumping at the supermarket, at the gas pump, at the major retailers, and everywhere else, you're being paid to buy houses because you can expect that over the long term, the rate of inflation will be higher than the cost of servicing the mortgage. That's a result of the Federal Reserve's most expansive monetary policy in history and the most profligate fiscal policy in peacetime and also in American history. Now, this is not a transitory or short-term or passing event. It's got nothing to do with the reopening of the economy and temporary problems of supply chains. This is a long-term decision to hedge against inflation by shifting household portfolios towards houses. It's a rational move on the part of households who know that for most people, the only really good long-term inflation hedge is houses. We're looking at deeply embedded, aggravated inflation expectations that are affecting the decisions of millions of Americans. That is an inflation cycle. The Federal Reserve can do its Groucho Marx routine and say, who you're going to believe, me or my own eyes, and talk about transitory inflation for some period of time. And until the Federal Reserve actually does something about it or threatens seriously to do something about it, the stock market will look at the Fed's hands, not at its mouth. But this can't last forever. The last time we had this kind of inflation in the 1970s, we had a dollar crash and a bond market crash and a stock market crash. And the only asset class that yielded positive returns after inflation during the 1970s was not stocks and not bonds and not cash, it was houses. So look at what the American public is doing with their portfolios, with their pocketbooks, as a gauge of inflation, and be afraid. Be very afraid. This is David Goldman speaking to you from New York City.